Hi guys, welcome to Learn Trade and Earn Forex. I am Tim Ambrose, your host and surest plug to consistent profiting in the Forex market. Just in case you're new to my channel, do well to hit the subscribe button and notification bell below so as to be the first to get notified when I upload another educational and amazing video. Also, if you're new to Forex, please see my previous videos for a step-by-step approach to becoming a pro in this market. You can also get every information you need, like the broker I use, my trade setup group chat, and how you can get in touch with me in the description area below. Thank you.
Just as it is important to look for perfect entry points to get into a trade, candlesticks are one of the most relied on tools in the Forex market that give good entry points. So today I would like to talk to us about the candlestick patterns. Candlesticks are ways of communicating information about how price is moving. Price action traders rely on candlesticks because they convey a great deal of information about each trading period in a visual format that is easy to interpret, allowing traders to compare the behavior of price in different time periods with a quick glance at a price action chart. Each candlestick can be read as a meaningful part of the developing narrative of price. They communicate the market sentiment, whether and to what extent bears or bulls were in control, and how far traders manage to push price in both directions. So, relying on candlesticks are good for getting good entry points in the Forex market. Candlesticks, to the best of my knowledge, don't tell lie. They will only deceive you if you don't follow the trend. So when you're following the trend, candlesticks don't tell lies. At least they are right 90% of the times if you are following the trend. So this is the structure of a candle. This one here, the white, is the bullish candle. That is a long or buy candle. So this region is the body, the real body. Here is the close, this is the high. At this point is the low, the open, and this is the low. So this thread here is called the lower shadow, while this one here is called the upper shadow. So for a buy bull or a bullish candle, it opens beneath and closes above. The high is the highest point the market got to. So when price gets to a point and retraces, it gives a sign, that is, I have gotten to this point initially. So the same thing for the lower shadow is a sign that price had gotten to this point but was not able to stay at that point. So this is the black is the bearish or short candle. So this is the real body. This is the real body. This is the close. This is the low. This is the open. This is the high. Now you can notice between the bullish and the bearish candle. For the bullish, it opens below. For the bearish, it opens above and closes below. So every other thing the same, just the open and the close of the candles. Examples of candlesticks we have, there are a whole lot of them, but I'm interested in explaining this sort of doji. This candle has zero or almost range between its open and close. Rather than implying potential reversal or a clear dominance of either bulls or of either bears or bulls, this candle suggests indecision or balance between the two forces. So a doji, opens and closes almost at the same point. A doji opens and closes almost at the same point. So this candle does not tell you anything. The only thing it tells you is, hey, this is an indecision. We don't know who is stronger here. The buyers and the sellers, okay, both are pulling weight. So if you see a doji, I will advise you wait for the formation of the next candle. Wait for the next candle to close for you to decide what to do. Yes, also key support and resistance area are important when trading the forex market. Neither buyers nor sellers are fully in control. That's the meaning of a doji. A doji that occurs in the context of a strong trend implies a weakening of the dominant force that resulted in that trend. Now, if a trend, let's say the price is trending upward, and that's a strong trend, and all of a sudden you begin to see there's a formation of a doji, that does not mean the trend upward is weak. It implies the weakening. So for instance, I have been in trades where there is where a doji appears, and after which price continued trending in that same direction for over 50 to 60 pips before a significant fall. So don't just see a doji and jump in. Remember I said, if you see a doji, wait for the formation of the next candle. So these are the 4 different types of dojis we have: the long leg doji, the dragonfly, the gravestone, and the 4 price doji. So these ones people pay attention mostly to the long leg doji because it appears almost all the time. Remember we said the doji opens and closes almost at the same point. So this is the long leg doji, this is dragonfly doji. Now, and gravestone and 4 price. When a doji forms on your chart, pay special attention to the preceding candlesticks. So when you see a doji, don't just initiate a buy or sell. No, wait for the next candle to close. That will tell you what is going to happen. If a doji forms after a series of candlesticks with long hollow bodies like white morubuzu, the doji signals that the buyers are becoming exhausted and weakening. It signals that buyers are becoming exhausted and weakening. It does not mean they are exhausted or they are done. No, you can get ready and begin to wait for a good entry position to short the trade or sell the trade. Don't just initiate a sell immediately. Price could drag you way beyond your imagination. In order for price to continue rising, more buyers are needed, but they aren't anymore. Sellers are licking their chops and are looking to come in and dive the price back downward. It is better for you to lose few pips than for you before you enter, that is, you wait for a perfect entry condition, than you diving in and the market drags you to an unimaginable region. Many times price will tend to return back to the original position, even go below it, but you may not be that patient. It may have haunted your stop loss. It may have haunted your stop loss down. So I say you wait until you see good signals. Hammer. A hammer is a candlestick with a small body, a small range from open to close. The body of a hammer is small, so a long wick protruding below the body and little to no wick above. When a hammer appears at the bottom of a downtrend, its long wick implies an unsuccessful effort by bears to push price down and a corresponding effort by bulls to step in and push price back up quickly before the period closed. As such, a hammer candlestick in the context of a downtrend suggests the potential exhaustion of the downtrend and the onset of a bullish reversal. The neckline, often determined by the high of the previous bar, is the level that price must hit on the next candlestick in order to confirm the hammer reversal signal. This is a hammer. So it appeared at the end of a downtrend. So if you're to take the trade, most persons are always impatient. They take at the close of this candle, they initiate a buy, and Yeah, sometimes this will reverse and go against you. So decide what you want to do before you decide to initiate your trade, your buy. At the close of this hammer candle, make sure you have practiced on the demo account which one works perfectly. Practice initiating immediately after the candle, the hammer forms, and at the close of the next candle. Remember, it states that the neckline, often determined by the high of the price previous bar, is the level that price must hit on the next candlestick in order to confirm the hammer reversal signal. So most persons will wait for this second candle to close somewhere around here, and at the close of the second candle, that's enough confirmation for them. Then they initiate their buy. So this is a GBP USD daily chart. You can see what we have here. For me, I don't wait for the next candle to form. Provided I see the hammer on a trend. So you can see price is trending upward, and all of a sudden there is a pullback and there is appearance of a hammer at this point. Remember, it is stated that the hammer has a long wick projecting below the body, a little to no wick above. So you can see little or no wick above. So that is it. I will initiate at this point. At the close of the at the close of the candle. So I would have initiated a buy at this point, and my take profit would have been at the resistance or the last pullback. That's where my take profit would be. My stop loss is always a little bit below the thread. I don't go below that. My stop loss will always be a little bit, and you can see if it's a buy trend, comfortably you can ride it as long as you want, but don't be greedy. Trend can change. So the next we have is the hanging man. The hanging man is the name given to a candle that is identical in shape to the hammer. The difference is that while hammers occur in downtrends, the hanging man pattern occurs in uptrends. In this case, the wick extends down contrary to the uptrend and suggests the emergence of bearish demand capable of pushing the price down. It is often the first sign that the uptrend is exhausting. So when you see a hanging man at the top of a trend, is an indication that the buyers are becoming exhausted, and it could signal the emergence or the beginning of a bearish demand. Now this is a hanging man we have here. You can see price was ascending upward. At this point, this is the appearance of a hanging man, an indication that price is a possible reversal. So what happened? Price began to move down. See what we have here. This is a channel. The market was initially trending upward. This is a GBP USD daily chart. Price was initially trending upward. On getting to this point, what happened? This is the appearance of a hammer, and price fell down and even broke the channel. So I would have initiated the trade at this point, that is at the neckline. I would have initiated the trade at this point. Now you can see we have a channel here, so I would not place my stop loss just above this. No, that's risky. If I've done that, you see it will have hit it. I would have been sent out of the market. Now I'll place my stop loss just raise it up to touch the channel to avoid being sent out of the market quickly. And most persons tend to use 10 to 15 stop loss to target a profit of over 100 and something pips. That is nice, but it's risky. Price can easily hunt that stop loss. So I prefer to use over 30 to 50 pips stop loss when taking a trade. So that's the hanging man here. I raised my stop loss up to the trend above, the channel above, and look at the take profit at this point. So that's nice. The shooting star. This candlestick is simply the inversion of the hanging man. It has a small body and a long wick protruding above it, with little to no wick below. The shooting star occurs at the height of an uptrend. Its long wick implies that resistance to further bullish movement has been encountered above the close, and a bearish reversal may be imminent. So the shooting star is an indication of a bearish reversal. So at the end of a shooting star, appearance of a strong bearish candle can be a good sign as for entry confirmation. So this is a shooting star. You can see price was trending upward. So on getting to this point, what happened? Started at the appearance of a shooting star, it started falling. So most persons will wait to enter at the close of the next candle, and while some will enter just right here immediately. So from this is GBP USD daily chart. You can see price ascended upward, and at the appearance of a shooting star, what happened? Price fell. So if you respect the trend, you would enjoy the profits in that trend. So we would have initiated a sell at this position at the close of the shooting star, and your stop loss could be, right, like I said, mine is always at the peak of the candle. Then the take profit could just at the trend line. Maybe it touches the trend line, you're out. Also, we have the evening star, a long bullish candle. The evening star consists of 3 candles. First is the long bullish candle. Second, the small bodied bullish or bearish candle, a doji that opens at or above the close of the previous candle. And the third, a black candle that opens at or below the low of the previous candle's body and closes at or below the center of the first candle. So this is the evening star. This is the first candle. Then the next candle could be a doji or whatever, but the third candle has to close at the midpoint of the first or below it. So let's check the chart. On the chart, you can see okay, just at this point, you can see this is the first candle. Then the second candle closed below the midpoint of this bullish candle. So what happened? Rise fell. So if you had pulled out the trend line, you would have known, okay, just respect the trend and follow the trade. So you initiate your sell at this point, and your stop loss could be at this point. The take profit could be at the next support. So you see that's the fair trade. The next we have is the morning star. Morning star is just the inverse of the bullish of the evening star. Mind you, the evening star is looked for at the end of an uptrend. So if price is trending upward and getting to the point, begin to look for evening star. Don't look for evening star below. What you find there is for morning star. Okay, so now this is morning star. Price was trending downward. Then what happened? The appearance of the morning star reversed. So from the chart, you can see at this point, price was trending upward, moved up with a very strong bullish momentum, a little retracement, and bam, that's the morning star confirmation we need as a price continuation. So you can see the trend. So what happened is a sharp trend of over angle 70 degree. What happened? Price moved in that direction, and Jackpot Valley, you can see this is a support zone at this region. So price respected it and moved upward. The bullish engulfing candle, the bullish engulfing pattern is a 2 candlestick pattern that signals a strong up move may be coming. it happens when a bearish candle is immediately followed by a larger bullish candle. This second candle engulfs the bearish candle. This means buyers are flexing their muscles and that there could be a strong up move after a recent downtrend or a period of consolidation. So the bullish engulfing candle, you look for it also at the end of the downtrend. When you find that it's an indication of price change in direction. To look at this, we have an uptrend here. So first point, second point, third point. At the touch of the third point, what happened? We got a bullish engulfing pattern signal, which is an indication of a buy. So what happened? You would have initiated your buy trade at this point. Now you can see I did not use this end here as my stop. So I used this structure here as my stop. So price moved in that direction. So some may have loved to put their stop at this structure. It just depends on you. But I weigh my stop, my risk to reward ratio, like I said in the previous videos, 1:5. So I go for such trades. Now the bearish engulfing pattern is just the same, the opposite of the bullish pattern. This type of candlestick pattern occurs when the bullish candle is immediately followed by a bearish candle that completely engulfs it. This means that sellers overpower the buyers and that a strong move down could happen. Not will happen, could. So after seeing these patterns, there are times in the market, the price will go against you. So but over 100% of the time, you find these patterns. 70% to 90% of the time, it goes in your favor. So that is why I prefer you always look for your candle patterns. If you're buying, look for it at the end of your downtrend. If you're selling, look for it at the end of an uptrend. So respect the trend. So this is the GBP USD. And you can see what happened here. Price was trending upward. So at this point, price, the bearish candle engulfed the bullish candle with a strong momentum. So what happened? Price went in that direction. So you can see I used the tip of this candle as my stop, and that's it. You take profit down at this point. So the risk to reward ratio is good for a beginner. For now, I don't think beginners should be looking towards 1:5. If you're doing that, do that in a demo account, but if you need money, please don't go for that in a live account. Your heart may not be able to hold that, you may get scared. Now the 3 white soldiers or 3 black rows. The 3 white soldiers pattern is formed when 3 long bullish candles follow a downtrend, signaling a reversal has occurred. That's for the 3 white soldiers. So at the end of the downtrend, you see 3 bullish candles follow a downtrend, the 3 candlesticks going upward. This type of triple candlestick pattern is considered as one of the most potent in the yield phase bullish signal, especially when it occurs after an extended downtrend and a short period of consolidation. The first of the 3 soldiers is called a reversal candle. It either ends the downtrend or implies that the period of consolidation that followed the downtrend is over. For the pattern to be considered valid, the second candle should be bigger than the previous candle's body. Also, the second candle should close near its high, leaving a small or non-existent upper wick. For the three white soldier pattern to be completed, the last candle should be at least the same size as the second candle and have a small or no shadow. So for the 3 black rows candlestick pattern, it's just the opposite of the 3 white soldiers. It's formed when 3 bearish candles follow a strong uptrend, indicating a reversal is in the works. So the second candle's body should be bigger than the first and should close at or very near its low. Finally, the third candle should be the same size or larger than the second candle's body with a very short or no lower shadow. So let's see the chart. This is the three white soldiers. What happened? This is this engulf this. This one is bigger than this, and this one is bigger than this. So it's signaling. It signals that the bulls are in power. So three white soldiers, look for it at the end of a downtrend, not at the end of an uptrend. To go for uptrend, what you're looking for is three black crows. So from this chart, you can see what we have here. So the trend, the market is trending downward. So now, like I said, if you respect the trend, you'd enjoy it. So what happened? I would have waited for this stuff, look for it at the end of a uptrend, but you can see this is a downtrend and it gave me a good signal. You can see this is the first signal, this is the second signal. So it's a sign of what? Bearish reversal. So that is why I would have taken this guy here. So some other persons may not be able to do that, but that is why I said before you try any of these things in your live account, make sure you've played with it properly on your demo account. Make sure you do that. Now for the three white soldiers. This is a downtrend. At the end of the downtrend, you can see consolidation. Remember from the little notes here, it said, especially when it occurs after an extended downtrend and a short period of consolidation. So we have here a short period of consolidation. This is a 4-hour time frame, so this should be over a day and a half or two. So period of consolidation, then there we match the three white soldiers to the first, second, third, signaling the uptrend. So what happened? You have initiated your trade here, stop loss at this point, and you take profit to the way up at this point. So that's for the three white soldiers and the three black crows. Now we have the tweezers patterns. The tweezer patterns, these are dual candlestick reversal pattern. This type of candlestick pattern are usually spotted after an extended uptrend or downtrend, indicating that a reversal will soon occur. The most effective tweezers have the following characteristics. The first candlestick is the same as the overall trend. If price is moving up, then the first candlestick should be bullish. The second candlestick is opposite the overall trend. If price is moving up, then the second candlestick should be bearish. The shadow of the candlesticks should be of equal length. Tweezers top should have the same height, while tweezers bottom should have the same low. So this is the tweezers we have here. At the end of a downtrend, you find the tweezers bottom. End of an uptrend, you find the tweezers top. Now let me say this: you will not find them perfectly like this on your chart. So, but if you know how to identify supply and demand zone, when you find these stocks there, even if they don't look perfect like this, you know these are the tweezers top or the tweezers bottom. Look at what we have here. I identified this zone and the market was on an uptrend. So what happened at this point? I just know, oh, this is a tweezer, the tweezer's bottom, and what happened? Price went in that direction. So if you're looking for perfect ones without thread, you see you would have missed this entry and you missed money. So the three inside up candlestick formation is a trend reversal pattern that is found at the bottom of a downtrend. This triple candlestick pattern indicates that the downtrend is possibly over and that a new uptrend has started. For a valid three inside up candlestick formation, look for these properties. Number one, the first candle should be found at the bottom of a downtrend and is characterized by a long bearish candlestick. The second candle should at least make up all the way up to the midpoint of the first candle. The second candle is a bullish candle. The third candle needs to close above the first candle's high to confirm that buyers have overpowered the strength of the downtrend. So this is a three inside up. This is the first candle, a bearish candle. The second one is the bullish, which closed at the midpoint, so just a little bit above it. Then the third candle, this is it, closed above the high of the first candlestick, which is an indication that buyers are taking over. So what do we have here? Yes, so this is the first candle, this bearish confirmation. The second one, you can see over the midpoint, and the third one, wow, engulfed. It's moved above the high, far above the high, and that's a good point to take the trade. Remember, this is an uptrend, so it's a good point. So what happened? You would have placed your take profit at this point. Hey, no, I don't go for bigger take profits when I find entry or structures on the 1 hour time frame. I will only go for 1:5 on the daily time frame or on the weekly time frame, not on the 1 hour or 15 minutes time frame. I can find the structure on the daily time frame, go to the 15 minutes time frame to look for good entry points, and my risk to reward will be determined on my daily time frame. But I wouldn't look for a structure on the 1 hour time frame and expect to give the 1:5. No, I don't do that. So take note of that. Smaller time frame, smaller take profits, smaller stop loss. Bigger time frame, bigger take profits, bigger stop loss. So the 3 inside down, this is just the opposite of the 3 inside up candlestick formation. Is found at top of an uptrend. It means that the uptrend is possibly over and that a new downtrend has started. The 3 inside down candlestick formation needs to have the following characteristics. Number 1, the first candle should be found at the top of an uptrend here, and it's characterized by a long bullish candlestick. So the first candle is a long bullish candlestick, but for the 3 inside up, the first candle is a long bearish candlestick. Now the second candle should make it up all the way down the midpoint of the first candlestick. So the third candlestick needs to close below the first candle's low to confirm that sellers have overpowered the strength of the uptrend. So that's what we have here. The first candlestick is a bullish candlestick. The second one has to close at least below or the midpoints of the second one. It's a sell candle. Then the third one must close below the low of the first candle. So let's go to the chart. You can see what we have here. Price is trending downward, and this got a good confirmation here. This is a bullish candle. The bearish candle got to the midpoint, and the third candle closed below the low of the first candle. So that's a good risk to reward. So I use this point because there's a demand zone around this region. So that's why my take profits could be this wide. Now the inverted hammer. The inverted hammer is just the opposite of the hammer we treated, which happened to be the second candle pattern we treated here. So the inverted hammer is just the opposite of the hammer. So we look for the inverted hammer at the end of a downtrend. See, price is trending upward. So immediately you find the inverted hammer, you see the hammer just upside down. Immediately you find the inverted hammer, you know, okay, so price is about to shoot upward. So what happened here? You can see the stop loss is relatively low because this is an uptrend. The take profit, I use this zone as my take profit. So you see, it took price 2 days to get to that point. So now I said previously, okay, so this is my counsel to everyone. This is my counsel to everyone. Make sure when you're using the candle patterns that you respect the trend. Please don't go against the trend. Please don't go against the trend. You'll be amazed how the market will blow your account. I hope you know a 10-cent lot size can blow an account off. So please don't go against the trend. Respect the trend. The trend is your friend. Respect the trend and you will enjoy the market. So thank you. God bless you. See you in the next video. So if you've not subscribed to my channel, do well to hit the subscription button and the notification bell so as to be the first to get updated, to be notified when I update another app, when I post another amazing and educational video. Also, in the description area below, you can get every other information you need. about my trades and how you can get in touch with me. See you in the next video. Please give this video a thumbs up, share with your friends, share with your loved ones so they also can make it big in the Forex market. God bless you. I love you and stay safe.